strengthening? Is the trend weakening? Of course, above the zero line, you have a strengthening type of situation, which means that normally if you were trading using this indicator, you would be long. And if it's below, it would be a weakening type of trend situation, and you would want to be short. A couple of other points, if you are looking at this particular type of a indicator, that is very helpful, at least I think so sometimes, is when you look at the situation related to what is going on with price and the indicator. You can see back in September, the prices continued to make a lower low, but the indicator, the predicted difference, was making a higher low at the same time. The underlying force of the market was indicating that this predicted medium-term moving average was moving to the upside relative to the actual moving average, kind of a little upward pressure, a little thrust going on, giving it a little bit more oomph. By the same token, when you look up here and a little bit later, you look in October, you can see the prices continue to advance to a higher high, but the predicted difference made a lower high. Again, the underlying force that was in there indicated that the market could potentially face some weakness because the oomph that it had in making the initial move wasn't as strong as it was, in the beginning. Now we want to add a couple of another indicator here and talk to you a little bit about the significance of that other indicator. We're going to add the long-term indicator. Now, what you can do, if you like, depending upon your time frame for trading, is that with the Vantage Point software, you have short-term, medium-term, long-term. The combinations are determined again by the neural network process for the particular time period you're trading. And when you look at the differences in here and you look at the clues you can get from here, the important thing is in the different lengths is to find out where you have the crossover type of situations. You can see here where the predicted medium-term difference starts to move up a little before the predicted long-term difference. And you can see the same thing is true here where it starts to take off and move to the upside. It moves ahead. It provides an early alert. The crossover type situation is an important indication, a little bit of a finer barometric pressure reading that indicates the market may be set to move up. You can also see that when it crosses down, some of the oomph has gone. It's kind of losing its pressure a little bit. The intensity of that trend strength is not what it once was, but it's not done. We're still above the zero line, so there is still some potential for kind of a strong trend, not as strong, but still a strong trend that can keep the market moving up. So you need to keep your eye on that as an indicator of what kind of momentum we have and where the changes in thrust are going up, where the trend strength is picking up, where it is slowing down, kind of what's going on in the underlying parts of the market, if it was going to continue or if it's going to change. But now all of that we have still, we don't have a real clear way, where are we going to place orders? We have a lot of sense of where the direction is. We kind of have the sense of the momentum. We know kind of the feeling of the market. Just as this is with weather, we know that in the case of weather, when certain things happen, like at least where we're at, we know if we have a hot, humid day, we can probably expect some kind of rain or storm to come up in the very near future. Or if we have a snowstorm sometime, we know that quite often we're going to get a cold blast of air to follow that. And that's just kind of the way it is with weather. Same kind of thing can be applied to the markets. We're going to cut back our time frame here just to 2 months to get a zero in a little bit better on the situation. And we're going to look at where we might place some orders. Now, we might be able to place them at above or below certain candles, depending upon where they are in the pattern and how they're doing. We also can place them above or below previous highs or lows. That also is a clue. But we've added here the predicted high and the predicted low. It's a next day forecast for what lies ahead for the market, and at least based upon the volatility, based upon what has happened in the intermarkets and what is going on with the market itself. When we look at that, we can see right here, for example, that's not a true candle. That happens to be the predicted range for today, for November 17th. predicts the predicted high, predicted low, and the price can be expected. The probability is it will stay within those range, and certainly not a guarantee, but that it will stay within that range. So we can use the predicted high and low as a kind of as a reference point, if you will, for trying to determine where to place our orders. Just to step back here to show you how we got into it, you can see here that we had a predicted high. This particular candle goes back here to October the 4th. The predicted high on that day was 11.15. Now to that, to make sure, and as a trend follower, again, I'm not trying to trade this on a scalping type of thing or anything like this, but trying to get a trend out of this. I'd like to have it really get into the trend before I jump on board. It's a situation, I don't want to be left at the station, when the train leaves, but I don't want to jump on a train that's moving too fast and, getting myself into a lot more risk than I can handle. But in this case, I use the average daily range, an approximate average daily range, as my point of entry. That means that above that predicted high of 11.15, I will use 40 points above the predicted high as my entry point, which would mean that I would be buying at 11.55. Now 11.55, it takes a day or two to get there, but comes in about right there, which would put you in a long position. Again, in a situation we described like the August, September choppy markets, you have to be a little bit more nimble. You may want to reduce that. You may want to approach the whole scenario a little bit different. Depends on your strategy, depends upon your approach as to how you might be able to handle this. But once I'm in this market at 11.55, then I don't want to risk more than 20 points. That'd be $1,000 in the E-mini. And that means that I would have a stop at 11.35. The reason is I could be wrong. This may not turn into a trend. I thought I waited long enough, and if it moved 40 points, it would be a trend, but maybe it's not. And if that's the case, if I'm wrong, I'd like to have protection and get out, and be able to determine that, I just simply made a mistake. I need to move on and look for the next trade. If you're looking here, you're looking at the predicted difference. If you see that line, if you said, okay, I'm going to trade on this predicted difference line starting to turn up, and it turned up there, you potentially could have used that crossover situation of the moving average. Let's say that you said it crossed over right here, and the predicted difference is going up. It's all indicating a long situation, and you're going to buy above that candle high. That would have gotten you long somewhere right in here around 11.74, 11.75, somewhere in there. In either case, however you get on board this market, then you want to make sure you have a stop in place in case it does turn around. And I use 20 points, half of the average daily range, as my exit point. So it's going to be 20 points below the predicted low. And you have situations here where it comes very close to coming down to that 20 points below the predicted low would be my exit. But for sure, when we get to that situation, we know that on